Good morning, ladies and gentlemen. Clueless Trading Frank, June 21st, 2016. Pre-market AM report on these very volatile days prior to the Brexit vote, which is a UK referendum on whether they should leave the EU, the European Union, or not. That is going to be the pivotal event on Thursday. And I believe that we shall, on our time, it should be, if I calculated correctly, then it should be by Thursday morning, our time. Okay, let's get straight into it. The behavioral dynamics part of my service is suggests, as far as I can see, intense fear, caution, trepidation, and a extreme lack of participation in the markets on a daily basis. That is not only true within our community here at Clueless Trading, but is very much exaggerated and amplified in the broader arena in the form of traders and investors shying away from embracing quantifiable tactical risk, and as well as a constant fear, almost a embedded fear that everything's going to fall apart every single time the market drops a few points. Technical analysis and the discipline and the focus that's required in following technical charts, indicators, and all kinds of other chart patterns is something that I would say, as I always say, more than 99% of traders, investors lack. The difference is that a few of the more passionate, determined, and persistent and diligent traders have the urge and the strength, mental strength, the key word is mental strength, needed to try to understand and follow. Many sit aside, always looking for the perfect moment. We're all guilty of that. No one is perfect. We know that. Human emotions, just in general, and I'm not the one saying this, it is true, is your biggest nemesis in the world of making money in financial markets. You have to think outside the box. You have to go against the grain. It doesn't mean that every time the market is down that you need to buy. But it does mean that if technical patterns are not broken, as I'm constantly showing in many different forms, both on the long side and sometimes on a tactical short side, then successful traders who will reap the benefits of their work in 24 hours, say for example from yesterday's close to this morning's open, for example on the S&P 500 calls, are going to reap the benefits or the rewards. But for the rest, who sit aside, as I like to say, SOA, sit on their you know what, and do nothing, there is no mercy, because they will not buy tactical pullbacks and they will certainly not buy tactical reflex bounces. So they never have a chance of making any real money. Trying to get into the market on a powerful up day is a futile game, because by the time your mind tells you that it's a good time to buy and you feel comfortable, it's too late. Because it's not just you, it's amplified in 100,000+ other, or maybe more, traders and investors who are feeling the same way. So if you keep on going with the masses, you're nothing but a lemming. There's an old saying that says, if you're not the lead dog, you're always looking at the behind of the dog in front of you. And that's not a pretty sight, right? So I'm not saying everyone is a leader and everyone has to lead and charge in, charge the cavalry into difficult markets. What I'm saying is you have to start taking the lead in your own mental framework so you can make some real money. And for that, it requires courage and confidence. And confidence and courage comes from hard work and some real grunt work in trying to understand what the charts are saying. So it doesn't matter what I produce out there, as I diligently do every single day. The videocast, the Periscope broadcast, the charts, the commentary, the economic news analysis and such. Many of you fail to make money because your mental amygdala, the part of your brain, which is the decision-making part of your brain, basically, or your animal spirit part of your brain, refuses to budge. So that is not something that I can help you with. That is something you need to help yourself. And once you cross over that barrier, that mental barrier, you too will embrace risk, understand what the risks are on the upside and the downside. And yes, there are risks on the upside. If you're short and the markets are opening up 5, 10, 15, 20 S&P points higher, it's not a good feeling at the open when you're way down. Saying all that, which I don't want to elaborate too much, let's get straight into the technicals. One thing I want to remind people, these are very volatile markets. The patterns are telling us something, which I'm going to go over right now. But the reality of the beast is that intraday, the volatility algos, which are the algorithmic high frequency trading programs, will make sure that you stay nervous, cautious, on your feet, and not be complacent. I am never complacent about the markets. Never. I'm always looking one eye behind the back and then looking forward. But I'm trying to read the tea leaves to a degree where my work can be somewhat predictive, as has been shown repeatedly. So let's get into it here. What we see here behind us is basically the backside of the market, which is the backstage of the market, I should say, which are the E-minis, the S&P 500 futures, which I track throughout the day, as you all know, and all of you should. So if you look at the pattern here on a daily basis, going back to April of this year, on this particular frame, you're seeing some very defined technical patterns, which, by the way, is a strong reminder, it is mandatory that every single member and trader review the introduction back to basics webinar that has been uploaded, which I did a free webinar this weekend, which has been uploaded on the Clueless A Trading YouTube channel. You need to refresh yourselves on the basics. If you do not understand basic chart patterns, you're not going to make it here. All right? Because trade management is key. You'll always do the most stupid thing. You'll sell on a market pulling back 50 points. You won't buy when the markets are rushing ahead. All kinds of stuff. So if you look at this defined pattern here on the daily, this is a daily chart going back all the way to April. You see that we had a rising wedge here. This is a rising wedge. Okay, right there. That's a rising wedge. Then you have a falling wedge. Okay, diagonal or whatever they call it. I call it wedges. And a rising wedge tends to correct. A falling wedge tends to break out. And a correct means breakdown. There are different forms of breakdown. Sometimes they're easier to read. Sometimes they get a little bit ugly, like we saw here from the first week in June. And now this is where we are. The most simplistic way of looking at this chart is that you have a pattern symmetry like this. And that pattern symmetry dictates that we either go up to 2100 on the which is roughly about 2107 or so on the S&P 500. Remember, you add about 6 or 7 points to the E-minis in order to arrive at the S&P 500 number, which also coincides with the gap fill, which I've shown repeatedly in all my charts in the past couple of days. So that gap fill should act as resistance. We could, at that point, this becomes a cup. It might create a handle, which is profit taking. That handle brings us down to test these rising mid-Bollinger right here, this gray line. And if the market does want to shoot higher, then it's going to make a move like this. Because a cup and handle in textbook terms generally creates a handle. How deep the handle goes, we'll see. And then it moves higher. Upper end of the Bollinger still remains around the 2130 level on the S&P 500. You can see that. And I think that's basically where that's where our max move is post-Brexit, if Brexit doesn't take place, if England decides to stay in the game. Can it go further higher? Sure. Now, what if Brexit doesn't happen? So if Brexit, I'm sorry, if Brexit doesn't happen. Now, if Brexit does happen, the downside, I've shown it a couple of times and I'll show it again. The downside would be that pre-Brexit, we move up here. A bearish viewpoint would be that this is a large head and shoulders, with this being the head, this being the left shoulder. So the right shoulder forms here. Should we move into that hard? And then we drop. The neckline happens to be around of this large head and shoulder. The neckline is roughly around, I would say around 2030 or 2040 S&P 500. So if we hold the neck, if we get straight to the neckline and we break down, then obviously you're looking at S&P 2000, E-minis 2000, and that type of number. In other words, we're going to get a sharp fall, probably 300 to 400 points or so on the Dow, real fast. So is there a method of playing this? No. You need to minimize your positions and not rush into the Brexit vote on Thursday with large positions standing. You need to be involved with a quantifiable risk. You can do a straddle where you could buy calls and puts, and the best way to play it is on the indices. So on the S&P 500, whichever way your bias is, and that's what betting is all about. And the market is nothing but a big betting system platform. So you can buy both calls and puts to hedge yourself, as well as stay participative, keep your participation in the game, because there's going to be a big move one way or the other. It's not going to be a huge move. Maybe on the downside, it might be a huge move, in my opinion. On the upside, if we keep on creeping higher, obviously a portion of that larger move towards 2120, if not more, is you're basically borrowing from the future if you move up too fast, too quick before Thursday. Now also keep in mind that Wednesday's coming up, and Wednesday is generally red Wednesday. So if we have a strong day today, take a good portion of your profits off the table, like I always said. I said it yesterday. Sell when you can, not when you're forced to. And then put some small trades in there, which you're going to benefit from, hopefully today, as the futures open up. Saying all that, we don't know what's going to happen minute by minute and what type of poll numbers are coming out of the UK. So there's going to be volatility. So pattern-wise, at least on the externals, which is the chart, it's still a it's this and possibly this. On the downside, a fast move from 2090, let's say 2090 S&P down to 2020 is 70 S&P points. That's roughly 420 to 450 Dow points. That's going to feel very ugly if you're heavily long and you don't have any short positions. I intend to have some sort of short positions going into Brexit, And I'll certainly alert people on that. Now, let's take a look at the internals. On the internals, one of the key reasons why I'm staying with the long trade or the long bias is primarily because of what we're seeing on the stochastics. It's not rocket science to see that the stochastics moved up nicely from here, created a double bottom before the big move up, and this is nice. It doesn't mean it can come down and create another double bottom or a higher low like it did here. So this could very well do this before it makes a move up. But this is a positive thing. It's creeping higher. So despite intraday volatility, and yesterday is an awesome day for tactical traders, you know. Long on Friday, huge moves on a lot of our picks, which I've listed on the Twitter feed. The S&P 500s were one of the best. From 8 to 23. Yeah, 8 to 23. When was the last time you owned a stock that went from 8 to 23? So remind yourself of that, please, okay? Priceline. Phew, I don't need to say it. It's up 50 points. Amazon. All were alerted last week, especially on Friday. Now, how you manage your trades and stuff, that's your business. You got to do it. You see big profits, you leave it out there without taking any partial profits. And I alert people, hey, you got to take, you know, I mean, like I say, you take 80% of your positions down. Or if you have a smaller position, take half down, whatever the case may be. If you don't do that, you're basically an idiot. That's the way I look at it. Okay, you got to bank some cash, bank the profits. You can take all of it out and say, okay, I got a day. You know, sometimes real tactical traders can basically finish their trading day in within the first half an hour of market opening. Get a good amount of money. You make a good amount of money on your overnight trades or your swing trades, and whatever the case may be, or trades what you bought prior to that big gap open or gap low if you're short. Take it off the table. Go for a nice walk. Try to find your inner self, okay? If you have one. So I'm serious, okay? I'm serious. And just finish the trading day. Go away. Because what happens a lot of times, you make a decent sum of money, and then you give it all back to the market because you're trying to overtrade. Try not doing that. We've all been guilty of that, but just try not doing that. Okay, so this is good. So this is as simple as you can get. The second thing we're going to look at is the McClellan oscillator. The McClellan oscillator is showing improvement, and that means there is a move coming. I like this. McClellan oscillator was oversold to almost minus 200. I was a screaming buy, and I was right. The last time the McClellan oscillator got to minus 200, we hit 2020 or so on the S&P 500. After that, it was just huge, and that was back in May. I'm not saying the same thing, can happen this time, but who knows? If we truly are robotic, if we are technically robotic or robotically technical, whatever you call it, then if you're following the McClellan and you're saying, okay, this normally tends to get smaller and then it gets green. Now let me see something here. If I'm missing something. Okay, so this is where we are right now. See this two yellow line? I mean the histograms. So we're about to go positive. So once you go positive, this is the momentum, okay? You normally have one or two bars. In this case, there was a lot of bars which accelerate. See the pattern symmetry? Remember geometry in school? Hopefully you passed the geometry classes. Look at that. So is it possible that you're going to have a pattern symmetry like this where the histograms keep on going bigger? It's possible. If Brexit doesn't happen, this is what's going to happen. We're going to get severely overbought. It's going to be like I said yesterday, shooting fish in a barrel. But we don't know that. That's the risk factor. But then if we knew everything, think about it. If everyone knew everything about what was going to happen in the markets, then all prices would remain stagnant and be fully priced or priced to perfection. Because there are imperfections in the market is what gives us the opportunity, gives investors